Hello everyone, my name is William Liu and I'm a Deputy Portfolio Manager for the WAM Global Fund, ticker WGB. I'm incredibly excited to be here with you today to share with you some of the insights from my investment process and how we're navigating the current global equity landscape. To refresh you on our investment process, WAM Global is focused on finding undervalued growth opportunities with a catalyst. We can invest all over the world and we're looking to find the best opportunities across Asia, Europe, and the US. We especially like finding companies with long-term compound earnings growth potential, and we find strong long-term earnings are the best predictor of share price appreciation over the longer term. Our big investment call over the next 12 months is that AI will drive a productivity boom, and there are huge opportunities outside of the infrastructure layer. So what do I mean by this? Where are we now? Currently, the market is obsessed about the AI infrastructure layer. Data centers, chips, and power at a massive scale are highly topical in today's market. And that is fair, given that they are the enablers of generative AI to function. If you look at the capital expenditure of the four largest hyperscalers, Microsoft, Meta, Amazon Web Services, and Google, it's increased almost fourfold over the last 5 years, and it's expected to reach $364 billion in this year alone. That is unprecedented in scale, and that number is likely to increase again next year. And it shows the focus and the amount of capital that is going into this space. Power demand in the US over the last 20 years has largely been flat. That is due to the adoption of energy-efficient technologies. Power demand over the next 20 years is projected to increase 40 to 50%, and that is still likely conservative. Data centers are highly power intensive, and we're seeing new frontier technologies such as autonomous vehicles and robotics, and that's only going to drive power demand higher. Utilities, which has previously been one of the most boring sectors in the global equity universe, are suddenly now a growth sector. So the AI infrastructure layer is an important component of the opportunity. However, we do note expectations, valuations are very high in this space, and we're being very selective and disciplined in finding the right opportunities and finding the right companies which satisfy our investment criteria. We're also focused, more importantly, on what happens next. AI is going to drive a huge productivity boom, and data centers, chips, and power alone do not do that. We're looking for opportunities of companies who are early in the AI adoption curve and are using this technology effectively and integrating it into their workflows. So to give you a sense of how meaningful a productivity boom can be for our economy, the closest analogy we can think of is if we look back to the 1990s. Between 1989 and 1994, cumulative productivity increased 4%. At the same time, the stock market increased 52%, which is a fair and reasonable outcome. In the mid-1990s, we saw Netscape introduced, which is one of the first internet service providers and the main browser at the time. We witnessed the almost threefold increase in productivity in the subsequent 5 years, and the stock market appreciated 250%. While we're not expecting the same thing to happen this time around, given the starting point of valuations, but we also know what happened in 2000, so it's important to highlight the risk management and the prudency in investing behind these frontier technologies. But it does show you the impact of a productivity boom, what it means for companies' values, and what it means for the growth of those companies over the longer term. We're positioned in early AI adopters, and we're really focused on finding companies with 3 key characteristics. Firstly, companies with leading technology stacks, which are really ready to integrate AI into their systems. Secondly, companies which are deeply embedded into their customer workflows and trusted providers. And then finally, companies with unique access to data, with contextualized data especially, that is a competitive advantage for them. And we own a number of companies with these characteristics across the portfolio. So let me move on to how the WGB portfolio is positioned. So we're positioned in the best companies across the different layers of the technology stack. We have the enablers, which is the AI data infrastructure that we talk about, but we also have the customized silicon and the software infrastructure stack. And then finally, the adopters, which is the application software, which will enable the productivity boom that's about to come. These are the companies which can improve the quality of service for a lower cost, automate tasks, and provide real value and new revenue models for their customers in the years to come. So today, I want to talk to you about 3 stocks. Starting with Quanta, which is a critical enabler of the data of AI infrastructure in today's market. I talked about how power is a critical bottleneck for data centers. In the US, the electricity grid has been significantly underinvested in for multiple decades. And we're at a critical juncture right now where there's a catch-up period and we're seeing a significant amount of money spent to modernize the grid in anticipation for data center demand and the electricity requirements that are still to come. If you look at the US electricity grid, over 70% of the transmission lines are over 25 years old. And then of the larger power transformers, the average age is close to 40 years old. So the infrastructure is aged, and there's a massive race to try and catch up and rebuild that infrastructure to be competitive in today's market. Quanta Services is one of the only companies which solve this problem. They provide physical infrastructure solutions to the utility companies and modernizing the grid, and they're in a golden age. In fact, this is reflected in their backlog, which gives us confidence of the earnings visibility for the years to come. Finally, I met the CFO in London at a presentation, and she highlighted one of the things that resonated to me was she talked about how over the last 10 years, Quanta Services has compounded earnings at an average growth rate of 25%, and this is despite being in an environment where power demand was essentially flat. Now that power demand is going up and inflecting upwards, we believe Quanta Services is going to be much more well-positioned, and there's significant earnings growth opportunities to come, and that's going to be a big tailwind for this business. The second company I want to talk to you about today is Synopsys. Synopsys is a leading electronic design automation software provider, and they are one of the largest in the space. They provide mission-critical software for verification, design, and testing, and they're an important part of the semiconductor supply chain. In fact, they are one of the key enablers of NVIDIA to be able to design its GPUs and high-performance compute units. We think the opportunity for Synopsys is threefold. Firstly, we're seeing increased research and development expenditure into chip design and complex chip design, and that's only going to continue. Secondly, we're starting to see Synopsys embed artificial intelligence across its products. This is helping its customers innovate quicker, find productivity savings, and that's going to be a significant tailwind for them. Finally, Synopsys recently integrated an asset called Ansys, and that's going to lead to a silicon to solution opportunity, which is a huge addressable market for the business, and we expect positive updates there to come. The third stock I want to talk to you about today is SAP, which is the leading enterprise application services provider listed in Germany. They are mission critical for their clients, and the customers trust SAP with their most important data for everyday operations in their business. In fact, over 70% of the world's transactions touch a SAP system, and you can see how crucial they are within the ecosystem. SAP has already launched a generative AI agents, and they're going to have a unique capability to have unique data sources, business contexts, and their trusted service provider who are embedded in their customer workflows. That's going to allow them to develop AI and going to create a significant earnings opportunity for them. In fact, they're putting their money where their mouth is, and SAP internally have targeted over 500 million euros in savings within their own company as a result of AI implementation. We believe the company is incredibly well positioned. They're going to be the ones who are going to increase the productivity of its customers by automating tasks with the right business context. And this is going to lead to a huge value proposition for their customers. And that is a great sign for us. So I hope those 3 stock examples give you a bit of a reflection on how the WGB portfolio is positioned, particularly in the context of AI. We remain focused and disciplined in investing in undervalued growth companies with a catalyst, and we remain focused on finding companies with that earnings growth potential. We're staying away from areas of frothiness in the market where valuations and expectations are high, and we're also conscious of the risk that AI can present and looking at avoiding companies with AI disruption risk. I hope that gives you an idea of how we're navigating the global equity landscape. We believe artificial intelligence is going to be a generational opportunity, but we are also being disciplined in terms of how we're evaluating the best opportunities. We think the productivity boom is yet to come, and we're laser focused on finding the best companies who will enable that future trend to come.